The guy you see next to me is the most generous billionaire in the world.
Hi, my name is Sam.
Sam has $22 billion, and he wants to donate all of it to charity.
FTX shocked investors by declaring bankruptcy this week.
It's one of the world's biggest cryptocurrency exchanges collapses.
This week, the multi-billion-dollar company run by Sam Bankman-Fried crashed.
Founder and CEO Sam Bankman-Fried has announced his official resignation.
The FTX collapse is going to go down in history as one of the biggest financial frauds of our time. But unlike scams like Theranos, which pretty much only affected high net worth individuals, in the case of FTX, it was mostly regular people that lost money, including thousands of people that watch finance educational content here on YouTube. So instead of retelling the story of FTX's downfall, which I'm sure you've already seen millions of times, I wanted to instead talk about some of the lessons that we can take away from this unfortunate situation so that we can grow as investors and make better investing decisions in the future. And I also feel like this video is especially needed in the YouTube finance space right now, because let's face it, most of the large finance YouTubers aren't going to talk about it because, well, they all took that hefty FTX bag and promoted it to us.
And if you sign up with our link,
signing up using my link,
there are referral links if you use my link below and the code name Tom Nash.
But before we get into what we can take away from everything that's happened with FTX, please make sure you like the video and subscribe to my channel for more videos just like this. It would really help my small channel grow. Alright, lesson number 1. Follow key investing principles. Warren Buffett famously said that only when the tide goes out do you discover who's been swimming naked. And this quote honestly fits perfectly with what happened in the collapse of FTX. Because as it turns out, Sam Bankman-Fried, crypto exchanges, and many other investors were in fact swimming naked. During the 2020-2021 crypto bull market, when Bitcoin was up double-digit percentages on what seemed like a daily basis, figures like SBF were viewed as geniuses. This was the time when crypto exchanges were making a fortune, and anyone that held large positions in crypto could be spotted in the break room at work with a smug face whilst flexing their Coinbase account balance to their coworkers. But of course, when the tide went out and the price of all major cryptocurrencies started to fall in late 2021, we started to see who was actually following sound investment principles and who had deviated or never followed these principles to begin with. The downfall of many of these bankrupt crypto exchanges wasn't brought on because crypto prices fell. In fact, believe it or not, Bitcoin is still up over 100% from its price 3 years ago. Some of the true underlying reasons for the failure of these exchanges is due to operating under large amounts of debt, risky trading practices, and a lack of portfolio diversification. And these are many of the same reasons for why millions of individual investors also got burned during the fall in crypto prices. I feel like in 2020, we all knew that one crypto guy. Because they made some good profits in crypto, they thought they were on some kind of next level genius when it came to investing, despite only getting into investing 3 months ago. They were likely invested in several different altcoins. Their investment portfolio was 100% crypto, and anytime you mentioned something to them about how you're dollar cost averaging into an index fund that tracks the S&P 500, they were taken back and said, yeah, I guess that's cool, if you're fine being rich in your late 70s. Like I said, these high-risk investors' portfolios were destroyed during the market-wide decline this past year, but the smart investors that stuck to the core principles of investing fared far better in the end, even if they had to look like straight boomers during the crypto bull run. There are, of course, many different investing principles to follow, but here are just a few that I think have been highlighted in the collapse of FTX. One being diversification. Having a diversified portfolio is probably the most important thing you can do when investing. Your investments should be diversified between a few different asset classes like stocks, real estate, and cash. Preferably, you should be invested in both equity and debt and spread between many different sectors and companies. That's why you'll hear me talk about index funds a lot in my videos. It might be repetitive, but these boring investments are diversified and are what truly build wealth for investors. Also, I want to highlight another principle that goes along with diversification, and that is that speculation is not the same thing as investing. Cryptocurrencies are still a new asset class that haven't been proven to provide a significant amount of real-world value. You can still put money into it, but it should be viewed as speculation and shouldn't make up more than 10% of your portfolio. And the last principle I wanted to talk about is leverage. Highly leveraged positions was one of the main reasons why crypto hedge funds like Three Arrows Capital and Alameda Research failed. I don't think it's a good idea for the vast majority of people to borrow money to invest with. That's a risk level that has become quite popular in recent years through margin trading on Robinhood, and I just think it's a risk level that most people are not prepared to handle when the market is in turmoil. Now let's talk about lesson number 2. Do your own research, don't follow the crowd. When it comes to investing, you've probably heard the phrase do your own research countless times, but the truth is that most new investors still don't do it. Instead, they take someone else's word for it. And I think that the FTX collapse has highlighted that even if you believe that the person or influencer that's recommending you a financial product is credible, you should still do your own research, because we have proof now that they might not have your best interests at heart. FTX promoted their exchange through massive celebrities like Tom Brady, Larry David, and Steph Curry. These celebrities and their teams most likely don't have any education when it comes to financial services. They don't know the risks involved with these crypto exchanges and how little consumer protection there is. But mainstream celebrities aren't the only ones with influence that promoted FTX. Over the last year, many of the large finance influencers here on YouTube heavily promoted the now bankrupt crypto exchanges, FTX and BlockFi. And as a finance YouTuber myself, I want to give my take on this, because I know many of the people that watch me likely also follow some of the larger finance influencers here on YouTube. I personally think that finance YouTubers like Graham Stephan, Andre Geek, and Meet Kevin should be held more accountable, more so than mainstream celebrities when it comes to the promotion of FTX or any financial product, because they simply should have known better. These YouTubers have established a level of trust with their millions of fans when it comes to advice on personal finance and investing. So when they promote an exchange like FTX, it really adds perceived legitimacy to that exchange. They knew that FTX and BlockFi were not FDIC insured, and frankly, they were okay with their fans taking the risks. I'm not trying to come at them or anything, because I genuinely believe that they didn't think that this would ever happen. But I do have a problem with the fact that their choice to work with FTX was not just poor judgment, but also was contradictory to the advice that they had given on their own channels. Take, for example, Graham Stephan. I've seen him give very good advice when it comes to investing in crypto. He talks about how crypto should only make up a very small portion of an investor's portfolio. He talks about how crypto is a speculative asset, and he's stated his opinion before on NFTs, saying that NFTs are pretty much just trash. But the problem lies in the fact that he gives these pieces of good advice in one video, and then in a separate video, he does an FTX brand deal, in which his whole purpose is to, of course, sell FTX to his fans as best he possibly can, which means getting his viewers to deposit as much money as possible into FTX. When doing the brand deal, suddenly there is no mention of only investing a small amount of your money in crypto or any other cautionary advice or warnings, because that would of course mean that less people would deposit their money into the exchange, which means less money he makes on these brand deals. Graham even went as far as promoting buying NFTs on FTX, despite having the opinion that NFTs are trash and essentially a complete waste of money.
What is your problem with NFTs?
I think so many of them are just trash.
Yeah.
I mean, let's be real here. They're created. There's no purpose behind them. There's no use behind them.
Buy cryptocurrency and NFTs with no fees. Use a crypto debit card. Track their entire crypto portfolio.
And like I said, it's not my intention to come at these guys or anything. I actually think that a lot of their advice is good, and at least they have since promised to be more selective with their sponsorships going forward. But as a finance YouTuber, I do think it's important to talk about this, since it's likely that their fans would have combined lost millions and millions of dollars from following the lousy recommendations of these YouTubers. FTX is filing for bankruptcy, and they get to walk away with hundreds of thousands to millions of dollars in FTX sponsorship money, whilst many of you walk away losing meaningful amounts of money, and the only compensation you're offered from these YouTubers is somewhat of an apology video, which is more so justification for why they aren't to be held responsible for their actions. Anyways, I know the saying hindsight is 20/20 somewhat applies to the FTX collapse and Sam Bankman-Fried, but I feel like there were some signs that promoters of FTX chose to ignore. For example, FTX CEO Sam Bankman-Fried literally described crypto staking as a Ponzi scheme, which was brought to attention by the YouTuber CoffeeZilla.
That is definitely a Ponzi scheme. So let's just check it out.
A surprising amount of legitimacy for what farming could mean. You know, where do you start? You start with a company that builds a box. And in practice, this box, they probably dress it up to look like a life-changing, world-altering protocol that's going to replace all the big banks in 38 days or whatever.
There were also many other things about SBF that never sat right with me, like his whole "I drive a Corolla despite being a billionaire" act, and how he had pledged to donate all of his wealth to charity. Many promoters of FTX took this at face value.
I'm not gonna lie, I've been following their founder, Sam Bankman-Fried, for quite some time, and he's a highly respected figure in the cryptocurrency space.
Meanwhile, his actions told us a different story. He wasn't a frugal billionaire. He bought over a dozen luxury properties in the Bahamas and was a massive political donor, and this was known information well before FTX filed for bankruptcy. And I just think that since we can't count on most influencers to do their proper due diligence or simply not sell out, we have to do our best to do our own research to protect ourselves from the next FTX type scam. But moving on to lesson number 3. crypto is the Wild West. Because when it comes to investing, crypto's the new asset class on the block that has very little consumer protections in place. You see, when you buy more traditional investments like stocks, your stock brokerage will have SIPC insurance, which protects investors in the unlikely event that their brokerage firm fails. Take for example, Webull, which is SIPC insured up to $500,000 and is also holding a promotion where they're giving away 12 free stocks for new customers when you sign up using my link below and fund your account with as little as 1 cent. Most modern financial institutions offer some form of protection. When you deposit money into a bank like Chase, not only do you have FDIC insurance up to $250,000, but the bank has to adhere to strict requirements on lending and the minimum amount of reserves they're required to hold. Crypto doesn't have any of these requirements that are essential in protecting the consumer. As we've seen with these bankrupt crypto exchanges, they don't provide any kind of insurance. They lend out as much of their customers' money as they feel, and they don't show proof of reserves. And even if they do, I would be very skeptical of it. Until the SEC finally catches up and properly regulates the crypto space, your crypto won't be truly safe on a digital exchange. So if you own a bunch of crypto and want peace of mind, the best thing you can do is move it offline into a cold storage wallet. So what I've talked about today are just some of the lessons I've taken away from the FTX disaster. I feel like if you diversify your investments, do your own research, and understand the risks involved with the asset that you're investing in, then you'll likely avoid many of the scams that are popping up in the crypto space and the financial industry as a whole. But I'm curious to know what your thoughts are on the FTX collapse and what lessons you've taken away from what's happened. So please do let me know in the comments below. I would really love to hear all of your takes. But that's it for the video. I'll see you in the next one. Take care.